Welcome, everyone. It's been a while, since we've done it. Just make sure this old machine hasn't been cranked up for a while. Let me know that it sounds okay and all that. I'm going to put the CNBC feed because the announcement will be out in just a minute. So, yeah, just let me know everything's good on sound, okay?
On the other side of this.
So let me make sure I'm real live on this. We should have the announcement here any second, so bear with me while I'm setting up some stuff. How's everyone doing, by the way?
Investment research. So, ladies, that's exactly right. I don't.
Oh boy. Hang on one second. Bear with me, folks.
Surprises in terms of what we expect
I'm all
from the
thumbs right
policy
now.
rate. No change there. I think there's a.
So wait for Steve Leisman to come up, and then we'll go live here. So, yeah, we'll spend a couple hours together today. I've got a lot to talk about. Haven't talked to you folks for a while, and I hope you're enjoying the Substack. Last night was the last free version. You're going to have to sign up. It's $8 a month, folks. I put a fair amount of work in, and I'm trying to make it very robust. I'm actually writing an article on ETF hacking right now, which will be included in that. There's a whole bunch of stuff. So I've kind of switched around what we're doing. So I'll talk to you about that here just in a few minutes. So I just want to make sure we have this live when we come up here. So I'm just waiting for this to come live. I think, where are we here? Yeah, we should be any second. I think there's a little delay here.
Going back just a little, though, about debt.
So, yeah,
It's just about flat. This is pretty much the holding pattern in Microsoft and
pretty weak day today ahead of this, which is
probably much more of that holding pattern as well.
Kind of interesting.
So keep an eye on that.
So I'll keep that background noise out. Anyway, yeah, we'll get it. Here we go.
Federal Reserve leaving rates unchanged at 5.25% to 5.5%, but making big changes to the statement. The statement twice mentions the possibility of changing the funds rate, setting out the circumstances for those rate cuts that maybe are nebulous, but maybe even a bit hawkish, depends on where you come from. I want to read you the statement that says here, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. It later says inflation has eased, but that it remains elevated. It's saying the committee will only cut rates when it's confident inflation is moving to the 2% target. No mention in the statement of whether it has that confidence. The statement also says, quote, in considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee removed that bias that was in there for hiking, where it talked about additional firming. That's no longer in the statement. The risks to achieving its dual mandate, the Fed says, quote, are moving into better balance. On the economy, there was an upgrade saying it's expanding at a solid pace, had said it was slowing in the prior statement. Job gains, it says, has moderated but remains strong, and it removed a section on concerns about the impact of tightening credit conditions. That's gone from the statement. It also removed a section on accounting for prior tightening and monetary lags. It was a unanimous decision with new voters Barkin, Daly, and Bostic and Mester voting as well. So cuts, guys, are obviously in play, but the Fed at best is not telegraphing any timing around it or amount, and you can be ready to suggest those cuts may come later than the markets now expect. Tyler?
Okay, so pretty much as expected. I put the reaction to the market up there. We're trading right now at 49.01, and this is where in the past the buy the dippers have come in and stepped into this market. It's been weak all for the entire session today. It was actually in the Substack last night. I did mention that market turbulence was on the way. That it's very obvious that we're getting a little frothy here, and especially coming into the final day of the month, coming into February. So make sure you get signed up for the Substack, because I'm going to go into some pretty in-depth stuff on the long-term outlook as we come into the beginning of the month. So we'll go ahead and talk about a few things. We'll watch the, looks like the market is trying to consolidate here at the moment, right around this 4,900 level. But let's get into a couple of things that I wanted to talk to you about, and I appreciate everybody coming. We got about 170. Be nice. I remember back in the pandemic days, we used to have 1,000 live. That was fun. We're going to get back, folks. I've been through a lot of personal issues that I've been dealing with, and things are kind of coming around. But my decision, before I get into some of the things I want to talk to you, my decision to take the daily commentary to the Substack was it takes me about the same amount of time. So I'm not looking at saving time. I'm trying to give you much better information and something you can put your hands on. In the beginning of the week, I have the entire economic schedule there, what the expectations are. It's really, I'm building it, and it's still coming together as I go through every week, but I'm building it as something you want to have on your desk all week on some of this stuff, and building some expectations. The market grid's in there, so you're getting a free market grid, those of you that have not bought the indicators. And but the everything I'm doing there on Substack is really, it's brought the hour-long, everything that's in there for the most part is what I was doing on the live streams every day. And so it's interesting because it's taken it from an hour down about 10, 12 minutes. And if I tried to do the 10 or 12 minutes on a YouTube video, it would not come across the same way, and certainly not have the depth of thought that I'm putting into this. So anyway, Kendall Report .substack, get signed up. Twitter's got a thing against Substack, so I'm not sure how many people are seeing the retweet when I launch it every night. So anyway, so let's get into some things that I think are really, really important, that were probably, just from the statement that they put out today, looks like they're moderating things. But I keep telling you, there's one thing that matters here, and the thing that matters is this QT. If they don't change QT, that tells you basically that there's still actually, while they're taking that selling off, what I'm looking for is when they stop selling, it's going to tell us what they think the risk is in the marketplace. I mentioned in last night's newsletter that there was around 7.7 trillion. I'm estimating somewhere between 6.5 trillion. So there's another $1.5 trillion of runoff to happen before we get to a level that I think they're probably going to announce that they're going to slow down or even stop the QT. And let me explain why I think that's really important. And to me, that's important because it now tells us what the balance sheet needs to look like on a relative risk basis. You know, we've seen the economy. If you go back, I see people talking about, going back and talking about 2008. It's 2024, folks. The economies have expanded crazy numbers, right? We're almost triple the size. Everything is tripled. So take whatever you thought it was big numbers back in those days, and you got to multiply by 3 or 5. And as you know, and I would just tell you, it's still anything I've done up to today on Substack is free. So you can do a free account and you can go back and look. And the reason why I mention that, if you didn't see the 2024 outlook, I think that's worth taking a very good read of, because there's some things that I'm talking about and really looking out toward more getting beyond the election. Well, who knows what kind of craziness is going to happen around that event. But as we come into 25 and 26, man, what I'm seeing here is some crazy potential in the markets. It's interesting. I'll get into a few minutes of this. We've got 20 minutes or so I'll go in. I don't know if this will end up being a rant or not, but there's something that's going on. Everybody, in my opinion, is focused on the wrong numbers, meaning everybody's talking about the debt and what the debt's going to be in 2030, and that's all it's that focus on the debt. Like, let's focus on debt. And no one that I'm hearing, I have a few people, I should say, I don't like global labeling to no one, but what you're really not, folks aren't looking at is what the potential growth of the economy is. Now, I happen to think that this is the fourth industrial revolution that's coming at us, and that AI is going to change we'll say, it will change how employment looks. I think there's going to be a lot of new jobs that will be created. Most folks are saying it's going to eliminate jobs and all kinds of people are going to be out of work. No, they're not. People will work. People want to work. There's productivity that's going to happen. And that's been my big argument, is that people will still we have a thing around here when we're doing process. We always ask the question, is there a man in the middle, or is everything quantitative? Is the computer doing the work? So in the case of our portfolio management and other elements, it's 100% being run by the computer. There's the only part of the man in the middle is a selection of the stocks that are going into the process. And that's the hardest part, actually, of everything. But what I'm talking about here is there's going to have to be interaction with humans to run a lot of this AI. And I think there's going to be an explosion in productivity, and therefore an explosion in GDP. And it's very possible that 3 years from now, we're going to see something completely different than what everybody's talking about. Everybody's talking about we're not going to be able to pay our debt. I'm saying we could grow ourselves out of this situation if productivity gets to some of the levels that I think it's going to get to. So take a read of that, because I think that's something to look at from that standpoint. So, just looking at, I got logged out of here. So market, just looking at a quick market update here. We're seeing that it's starting to stabilize a little bit here. And I suspect once Powell starts to talk, it'll probably rally back. So there'll be some good things going on there. So, and I see somebody talking about coming back to the Substack's way better, and I'm going to fill in the gaps with Substack by doing a video like I did on Sunday. There's going to be more content coming out on YouTube. It'll be more macro based instead of the micro day to day, and I think the micro day to day, I wrote that type of commentary for almost 20, 25 years every day for our institutional accounts. I've expanded what I'm doing every night. I'm actually really enjoying writing again. That's been good. And then, like I said, I've got a bunch of projects that you're going to be glad that I started writing again, because there's going to be procedure stuff put together for stock selection, portfolio construction, a lot of stuff. You folks know me through looking at charts and talking about what's going to happen tomorrow. Where the big money is in portfolio management, managing your 401k, all those kind of things. And I'm just migrating everything over. I'm in the process of basically rebranding all of my social medias right now, because basically there's a new message that needs to be out to who I am if you're looking to follow me. And because I am going to shift a lot of things. So I still have that technical analysis. It's nice to write it down. You can go back and read it. Be really easy for you for you folks to